So, good evening, friends. This is Deepak, and I wanted to share some of the insights that I learned from a client today. And that's the beauty being in this business. I get to learn from everyone. So, as much as you come to me for advice on your tax matters and other finance matters, I'm learning from you as well. So, what happened today was a client came in and he has suffered quite a bit of loss in his portfolio, and he was wondering where did he went wrong. And when I start asking him questions, I quickly realized that he believed in index investing. That's what his belief was. And as the S&P 500 started to fall, he switched from S&P 500 to high flying stocks, thinking that he can make his losses from those momentum stocks. And you know what I'm talking about, right? And as markets started to go down, those momentum stocks went down even more aggressively. So he actually lost even more money. Honestly, he hasn't really lost anything because he hasn't sold anything. So as long as he sticks with it, and if he believes that those momentum stocks will do just fine overall, then he will probably make all that money back up. But anyhow, at least for the time being, he feels that he has made a mistake. So, I mean, I don't know if those companies that he has chosen his portfolio would be good or not, but one thing I can tell is that changing your strategy can be quite dangerous because, especially in a volatile market, because just because you're switching from one strategy to other doesn't mean that's going to fix the problem, right? You really need to believe in your strategy and hold on to it for longer period of time for it to work. And if you keep switching from one strategy to another, then it's not going to work out that well. And there's a interesting story I would like to share with you that one time a bunch of monkeys, they were in a mango farm, and they were trying to get a bunch of mangoes from the tree, and the farm owner came and start pushing all those monkeys out. And once the monkeys were out, they all called in a meeting. And after the meeting was called in, the elder monkeys heard the problem, and they said, you guys are stupid. Why are you going into somebody else's farm and trying to eat their mango? Of course they're going to kick you out. They said, well, what do we do then? He says, well, you guys have some mangoes with you. Why don't you plant them and grow your own trees? And once you have your own trees, nobody is going to bother you. Now, so far, what I mean to say is I see many clients, they are investing, they're buying stuff because they are, doing things according to somebody else. Meaning that maybe they read somebody on Twitter, maybe they heard somebody on YouTube, maybe their friend, family member. Somebody was able to gain their interest, somebody was able to gain their trust, and now they think they can replicate the same success. So very similar story. In this case, all the monkeys, they said, okay, we are going to follow this strategy. We are going to plant our own mango trees, and then we will live happily ever after. And they did that. They took the mango seeds and they planted them. Except one problem. They kept going back every day, taking the seed out and see how much that of a mango tree they have grown. Obviously, if you take the seed out every single day, you're not going to be able to see the growth. And that is what's happening with people when they're shifting from one strategy to another. So figure out what works for you. Is it the index investing? If it is index investing, stick with it. Nothing wrong with index investing. The problem is people get so excited about making higher returns. Why? Because they saw some post on a Twitter, they saw a friend talking about it. Maybe they heard some, hotshot giving an interview on a television or YouTube or something like that, and they get like, hey, you know what, that guy is doing 20%, so I can do 20% as well. So please understand that an average investor is generating roughly about 3% return. Average investor. S&P 500 generally makes almost 10% over a longer period of time. So if you are an index investor, you're still doing better than a lot of other investors. So by investing in average product doesn't make you average. You're still performing above average. So that's one thing. Um, Similarly, I see people switching from S&P 500 to Nasdaq to Dow Jones to momentum stocks to small caps, large cap, mid cap, all kind of stuff. People moving things around. And like I said, there's nothing wrong with that. It's just that you need to believe in it. And believe in it for a long time, because if you're gonna, let's say if you've been invested in small caps for last 10 years, and you see, man, oh my God, these large caps has performed so well, but small caps haven't performed so well, and now I want to move from small caps to large caps. Well, what if the small caps start performing next year? You're going to be in trouble. So figure out what is it that you believe in. Personally speaking, what I like to believe in is that I share my portfolio allocation strategy a few times with you guys, which is very simple. No more than 5% in any particular company. I like to have at least 20 stocks in my portfolio. Whenever I take on a new company, I start out with maybe 1% position in that company and start learning more about it. How do they make profit? Who are their customers? How are they doing? Who are their competition? Do they actually have a moat? What kind of margin of safety do I have? What kind of track record they have? And so forth. And slowly grow my position into a 5% position over time. Sometimes I get the timing right, sometimes I don't. If I believe in the stock and the timing is wrong, then I do dollar cost averaging. If I think I made a mistake, then I sell it and get out of that position. That's my play money, basically, to figure out which company is going to be there. Now, what kind of companies am I looking for? I'm looking for companies that are going to do very well. That means they are going to have huge gains. And the reason being is just for the hypothetical example, let's say if I was putting my money in S&P 500, and we'll just say, let's say there were five stocks, and let's say stock one does 15%, stock does 10%, stock three does maybe 20%, stock four does maybe 18%, and let's say stock five had a loss for maybe 15%, 16%. The average of those five stocks will be roughly 11% gain, provided I spent the equal amount of money in all of those five stocks. So I made 11% return. Not bad, not bad. It's still good. However, if I'm able to identify a company that are going to grow at very higher rate, companies that will be able to generate good amount of earnings, good amount of profit, good amount of cash flows, those kind of companies, then what will happen is I'm going to get some big gains, maybe not 18, 20, 15%. I'm talking about 100%, 200%, 300%. And there will be some losses. Sometime I will make a mistake and maybe I will hit a 40% loss, 50% loss. Maybe I will be right only 30% of the time. Maybe I'm wrong 60 or 70% of the time. Even in that case, the math will still work in my favor because these are high growth companies. So that's my strategy. That's what I like to do. And that's how I play it. So I'll give you an example. Let's say company one has I made a bad choice. Maybe I'm down 40%. Company two, again, bad choice. Maybe I'm down 50%. Company three, maybe I made another bad choice. I'm down 60%. So you can see these are huge numbers. But let's say if I get two of those companies right, maybe one company makes 200%, maybe another one makes another 150 or 160%. If I'm able to do that, I will be making 42% return on average of those five companies. So that's the beauty of it. So either stick with this high growth companies if that's what you like, you want to be on that side, or if you like a little bit more stable environment, then stick with ETFs. And figure out what strategy works for you. There's so many of them. People are taking way too much leverage. People are moving from one strategy to another. People are sometimes moving from sectors to sectors. So the only request I would have is don't do it because somebody's telling you to do it. Figure out on your own whether that strategy actually makes sense for you or not. And try to learn. You don't. There's no rush. You don't have to go out there and make things happen. Sometimes people say, "Oh, CDs are bad because for many years they return nothing." I think CDs are just fine. I think you will do better than if you randomly trust people on internet and take risky bets because they're telling you something. I don't think you should be taking a risky bet until you actually understand the fundamentals of that business, of that company. You understand the macroeconomics environment. You have enough time to let that play work out. You don't need to access those funds, in case of emergencies. Have an emergency fund. I mean, many times I talk to clients, they don't even have an emergency fund, right? So some of the strategy that I talk about in our comprehensive consultation is, well, how do you set up an emergency fund that keeps on rewarding you? One of the main reasons why people don't have emergency fund is they feel like, waste of money, like they're not making anything on it. But that's not true. You can actually make money and still use it as an emergency fund, meaning you have an access to liquidity anytime you want, and you still make decent amount of money on it. So being able to get rewarded on that savings, that works. And another part is being able to automatically save. Sometimes I come across clients who are making $1 million a year, and they're well to do, but they still don't have an automated savings plan in place. A lot of people will invest in stock markets, or real estate and whatnot, whatever their favorite style of investment is, but they don't save enough, and that's a problem. And the reason why that is a problem is if you identify a company that is down 40%, 50%. For example, I think recently I've been watching news on Intel right now. Intel is down to almost bankruptcy level. That means if we were to liquidate that company today, that's what shareholders will get. I mean, this is a video I'm recording in August 9, 2024. So obviously, Intel will probably change by the time a lot of people will get to watch this video. The CEO of that company is buying more stocks of Intel. I mean, how many other companies that where the CEO is buying more of their own stocks? I mean, usually these people get RSUs, they get discount programs and so forth. So they have plenty of opportunities. But here we have a CEO buying a lot of their stocks. So what did that tell me? Well, that tells me there might be an opportunity here. I wouldn't do it just based on that. I'll probably study the fundamentals and see if the company can survive or not. But the key point I'm trying to make here is about savings, not about Intel. So please don't confuse it. And just as a reminder, none of this is the investment advice. These are just basic financial structures that we should have in place if we want to take advantage of market conditions. So if I had, maybe 20% or 25% of my portfolio in savings, where and I'm not, and once again, I don't want to discourage anyone by saying that, put your money that is earning nothing. That's not what I'm talking about. I'm talking about savings account that are still paying 5-6% a year. Those kind of accounts I'm talking about. And now some of you guys say, well, yeah, but that's just this year. No, I'm talking about on a regular basis. There are ways to make this happen. If you want to learn more about that, just book a consultation with me, and then we can talk a little bit more in details, step by step, how do you structure it. But the main point I'm trying to make here is have a automated savings plan in place that you can use when market presents you with huge opportunities. For example, Berkshire Hathaway, great company. They have a lot of business. Like that's like an ETF on its own because they have so many companies within that one bucket. And right now they're doing well, but maybe at some point they will go down as well, and maybe I want to buy that company at that point because there is a good opportunity. But I can't do that if I don't have funds in savings. Why? Because when market goes down, good companies go down, but bad companies go down even more. So if I have a lot of bad companies in my portfolio, obviously my portfolio going to get hit a lot more than if I had good companies. But if I have good companies in portfolio and I'm fully invested in those companies, then even then that kind of restricts me from taking advantage of an opportunity when it arises, and who knows when that will happen, right? That can take a long time. I mean, we take a look at Warren Buffett holdings right now, and we see he has, I think, almost 50% of it in cash, or maybe in treasury bonds. Now I think he owns more treasury bonds than the treasury itself. So very interesting idea. I mean, I think it's a great example of having an opportunity fund. I think Warren Buffett is just awesome for that. So I thought if it works for him and he's been using it for so long, I think it can work for many of us. But the problem is it requires a system. It requires reward. It requires consistency, and it requires patience. All right, those are the key elements that are missing, and honestly, I think that's why Americans are falling behind on savings. Our credit cards debt has been increasing. Our student debt has been increasing. Business has been taking a lot of debt. So our debt is, and not just consumer. I mean, look at our government itself, right? Um, so I think fundamentally our problem is really savings. I think if we can focus more attention on that, we can dramatically take advantage of opportunities when they arise, not just in stock markets, but everything else. For example, interest rate opportunities, your car loans, your real estate, your business opportunities. You can't do any of that if you don't have money set aside. Because when you have money set aside, nobody can take advantage of you because you have an alternative. You have another option. You have another way to get that stuff done. But when you're stuck, when you have to depend on one person, when you only have one way to do things, that's kind of makes it hard. For example, sometimes I'll have clients come in and they will have huge losses on their portfolio, and I'm like, what happened? Why did you sell it? Well, sometimes they sell it because of a medical emergency. They have no choice. Sometimes it's because of education. Sometimes it's because of travel. You know, um, and it breaks my heart that they all they had to do was just hold on. They just sold it at the wrong time. You know, um, and the reason they did not had an opportunity fund on the side. So anyhow, I think that kind of gives you some idea as to how I allocate my funds, how I look at my money and how I structure this. If you want to learn about how I do it, please don't hesitate to reach out to me, and I'll be happy to teach you how you can significantly reduce your risk while ensuring long-term financial success. It doesn't require you to be a mathematical genius or a finance genius. It's just some basic principle. Once you put in place, as long as you follow the principle, system works on its own, right? The reason why uh, I see some clients who are not doing that well is oftentimes because they're just missing out on some basic principle. For example, start savings early, start investing early. It's a basic principle. If we teach that to our kids, they're going to be successful in long term. People know it, but when they go to their tax advisors, to their financial advisors, do you think they're having that conversation? I mean, when was the last time your CPA, your EA, or whoever does your taxes had this conversation with you? Probably never. Nobody talks about it because nobody makes money off that, right? Only you benefit from it, but the other people don't. So they don't talk about that. How do other people make money? They make money when you buy some product from them, when you move your money to their accounts. So if you're not doing those two things, if you're not buying something from them, if you're not moving your money to their accounts, then they're not making money. And because they're not making, why should they spend time with you, right? So nobody is going to teach you. You gotta have to learn this yourself, and do it the hard way. Learn one principle at a time. Everybody knows not to panic when the market is down, but that's easy to say but hard to follow. Look at right now how many people are really panicking. I can feel it because I talk to clients every single day. Oh my God, what's going to happen? Is this market going to crash? We are getting into a war. I'm pretty sure they're going to be U.S. will be dragged into a war. Is what's going to happen with Israel? What's going to happen with Ukraine? Ukraine is now attacking Russia. This is going to turn into a full-fledged war. And then we have politicians who don't really make it that easy for us, right? We got Trump saying, "Oh, if I don't get elected, it's going to be like third world war," right? Stuff like that. At least that's what he's trying to portray, right? That he's the one who can save the world. And maybe he is, maybe he's not. I don't know. But the point I'm trying to say is politicians should really calm the market down. They should not get people excited, but sometimes that happens, right? Then we have other situations. For example, what happened with Japan? They raised the interest rates, markets start to panic. Why? Because um, uh, so this is an interesting one, right? Those of you guys who don't really follow this, so I'll give you a brief overview on it. So what a lot of institutions were doing is interest rates in Japan were low and interest rates in US is high. So very simple arbitrage opportunity. You borrow in Japan and you invest in US. Very simple. You make good money. Um, but you don't want to take a lot of risk. So what happened was a lot of institutional companies, such as insurance companies, a lot of retirement plans, those kind of people, they invested a lot of money using this strategy. And when Japan decided to increase the interest rates, all of a sudden, a lot of people panic. Why? Because they're like, oh my God, U.S. is heading towards reducing the interest rates. We just don't know when, but coming soon. And here we have Japan increasing the interest rate. This is going to create a big problem for us. So a lot of people went to the market and sold out and try to pay that debt back. Now, problem is, even today, like I said, August 9, even till today, we don't know how much of that sell is done and how much of is that left over. Are there people still holding on? Maybe they're waiting for markets to kind of balance, and maybe it can take a week, maybe 2 weeks, maybe a month, 2 months. I don't know how much of that money is sitting aside, but that's happening right now in the market. That's why we're seeing a lot of volatility. And like I said, and then all the other things around it don't make it easy either. Then there were people who came across and they said, well, what about Feds? Feds make a big mistake. They did not decrease the interest rate. A lot of economics came out and so like, I think Feds are again making a mistake. The market will, inflation is already cooling down, and the market is weak, economy is weak, so they should reduce the interest rate so that way uh, this trend can continue. So you can see there's no like one person at a fault here. It's like everybody's part of it. And let me give you some examples. So number one is that um, unemployment rates numbers came in, and people thought, oh my God, all of a sudden it's not looking good. But then numbers came again, looks okay. And now if next week numbers comes and they still look fine, then all of a sudden the market will cool down, right? We saw what happened with Japan. We saw what happened with Ukraine. We saw what happened with Israel. So all of this stuff is happening all at the same time, and that's what making people panic. At the end of the day. So a lot of people are thinking that if Feds don't reduce the interest rate soon, we can run into recession. Okay. Um, Nobody really knows what will happen. This microeconomics data is problem I have with it is how do you interpret it. It can you can read it in so many different ways. For example, what would happen when interest rates are cut? We all know they're going to happen. At least that's the common expectation. A lot of us are expecting it that will happen in September. Some people are expecting it maybe even sooner, maybe an emergency cut that can happen. I don't think that's going to happen, but we will have some sort of interest rate cuts pretty soon. But if I were to ask you what would happen with that, would the market go down? Would the market go up? So I think majority of the people will say, well, market will go up because interest rate cuts help people. But let me give you another point of view on that. What does the interest rate cut really mean? It means economy is weak, and if economy is weak, perhaps we are heading towards recession, right? So you can read that data in any one of those two ways. So which way are we going to go? Nobody really knows. Okay, then you might say, well, let's rely on a history. Okay, well, if you look at the history, it has gone both ways. Sometimes it goes negative, and sometimes it goes positive. So it really depends because economy is so huge and there's so many minor parts to it. It's very hard to predict if we are really going to hit recession or not. And if there is one person out in the universe who knows for sure, for certain, right, that guy will be the richest guy in the world, right? And I don't think anybody really knows this. So all this microeconomic data, yes, it's there, and yes, it creates noise. Yes, it creates problem in the short run, but over the long run, nobody cares. At the end of the day, economy is good. U.S. is a great country to live in. U.S. is a great economy. We have seen so many different problems in the past, and we overcome all of those problems, and we continue to grow ahead. We continue to move forward. So I think that's the same thing will happen in future as well. But at the end of the day, if you follow the basic principles, have a savings account, have some emergency funds, um, don't rely on other people, figure things out on your own, come up with your own theories, come up with your own principle, come up with your own valuation. I teach many valuation classes. I talk about different strategies I use for valuation. um, learn, but don't depend on anyone. Do not depend on anything I just said. Verify for yourself, like what I'm talking about, does that make sense? And if it doesn't, then call me out, because like, Deepak, that's wrong. This is now not how it's supposed to work. um, and by the way, if you have other strategies, the ways you do your business, then share it with me. Please put it in comments, reach out to me, let me know. If you want to partner up with me with something, you have, some great products or whatnot, definitely don't hesitate to reach out to me as well. I'm very open, always willing to learn stuff. But please, if your product or service is there to trick people, it doesn't really help them, it doesn't benefit them, then please don't reach out to me. Don't bother. I'm not going to entertain them. If I make a little less money, that's okay. But my clients, I don't want a single client who come back to me even 10 years, 20 years later and say, Deepak, you gave me a bad advice, or you connected with me somebody who was bad. So please help me out with that. I'm not interested in those kind of partnerships. But if you're willing to genuinely help people, genuinely solve their problem, you have something to offer them, then please definitely reach out to me. Once again, friends, thank you so much for staying with me. If there's anything I can do to help you with your taxes, definitely reach out to me. And I do a lot of meetups, I do a lot of webinars, seminars, so you are welcome to connect with me in those seminars. If you want to do a consultation about tax matters, or your savings matter, debt matter, finance, those kind of things, how do you structure proper retirement, we can talk about all that stuff. So don't hesitate to set up a consultation appointment to discuss all that. All right, guys, thank you so much. I think you'll find this information valuable. As the market changes, I'll try to share more ideas with you. But these are the kind of things that I've been seeing for the last 1 week with consultation appointment. So I thought I'd share it with everyone. Hopefully, you will find some value in it. Okay, thank you.